Kabzi, today gravity is going to teach us a lesson about stock investing, because you see, what goes up must come down. Salam folks, and welcome back to the IFG channel. Many of you have been asking us to make videos about alternatives to the stock market because you're worried about a potential correction coming within the stock market and you don't want to be caught when that crash happened. Now that's not a crazy concern to have, to be honest, because if you look at the S&P 500, the world's most prominent index, it has gone through the roof since 2020 and COVID and the pandemic, but you see that latterly it's had a big correction. And could there be a bigger correction to come and more volatility as interest rates are hiked up? Absolutely. Right, so let's talk about some alternatives. In this video, I'm going to give you 6 really good alternatives to the stock market, and we're going to rate each of these according to 3 criteria. Firstly, correlation with the stock market. Secondly, risk-reward ratios associated with each of these investment options. And finally, how accessible is this for the ordinary investor to actually get access to this stuff? Before we dive in, I wanted to share some really exciting news with you. We have just launched our brand new investing app called IFG Wealth, which allows you to compare halal investments from across the world. It allows you to track your net worth and generate actionable insights relevant to your portfolio. You can also calculate your zakat on the platform and write your Islamic will within 20 minutes. And there's much more coming in the future months, including a deep portfolio report that live updates as your assets update, and a series of IFG funds that give you access to investment strategies never accessible before, including, by the way, a bunch of alternative investments as well. The link is in the description below. Have a play and let us know what you think, and let us know what else you'd like us to add into this app as well. As ever, remember guys, we make these videos for educational and entertainment purposes only. Please don't consider this financial advice and do your own research. And remember, your capital is at risk when you're making investments. Crypto is the brand new asset class that everyone is talking about. Even the uncles down the high street have been having a bit of a punt on Bitcoin. For those of you who don't know what this asset class is, check this video out that we've done previously. But there's a big problem. You see, historically, crypto and stock markets were like this. They weren't correlated. But over the last few years, increasingly, we have seen crypto rising and stocks rising at the same time. Check out this graph of the S&P 500 versus the Bitcoin price. As you can see, Bitcoin has been aligning more and more with the stock market, and the correlation between the two has been going up. And that's not a crazy thing if we think about it, because the same generation that's been pumping up stocks, the GameStop generation, has also been keen to invest in crypto as well. So from a correlation perspective, I would have to give crypto a low mark of 4. But now when it comes to the risk-reward ratio, I would give crypto 8 out of 10, because I still think there's an immense amount of reward available. And sure, crypto is a riskier asset, but the reward here is commensurate to that. The other benefit is that crypto is a liquid investment, so you can get in and out of it relatively easily. And of course, I caveat all of that, guys, don't put 100% of your money into crypto. That's not what I'm saying here. But how easy is crypto to actually get started and investing in? Well, I would give this probably a 9 or 10 out of 10, because it's really easy to get started with crypto these days. You can get yourself started within a crypto exchange and set up and investing within minutes. Real estate is a quality asset that still remains very, very popular. Your investment is backed by bricks and mortar. The prices in this sector are pretty stable, relatively speaking, and you're highly, highly unlikely to lose much, if any, of your money. Importantly, real estate is pretty uncorrelated with the stock market. Here's a graph of the Vanguard REIT, Real Estate Investment Trust, versus the S&P 500. As you can see, pretty uncorrelated. Of course, the correlation goes up and down over time, but generally speaking, it remains uncorrelated. Overall then, I'd give real estate a correlation score of 6 out of 10. When it comes to the risk-reward ratio, the risk remains relatively low and the reward is not actually that bad. The UK property market has gone up by about 4.3% annually over the last decade or so, and you get yields of between 5 and 10% per annum still. So all in all, I would give it somewhere like 7 out of 10 on the whole. In terms of accessibility, real estate is a bit of a strange one because you can actually get hold of it pretty easily because you could save up and buy your own house, or you could go onto a crowdfunding platform and buy small stakes in lots of different properties. However, when it comes to accessing tier 1 high quality institutional grade property, that's much harder to do because then you need tens of millions of pounds to just buy one asset, and if you're going to build a diversified portfolio, you might as well forget about it. Thankfully, we are actually working with a leading real estate institutional fund that manages billions of pounds to give a portion of their assets so that we can sell it down to our investors on IFG as well. So watch out for that. Sign up to ifg.vc, the platform, because that's where you'll hear about it first. But for now, in terms of access to quality real estate, I would give it 6 out of 10. And now for a quick word from our sponsor, StrideUp. They're an FCA regulated finance provider that gets you onto the housing ladder faster with lower deposits and higher finance amounts. They're also certified as Sharia compliant as well. As someone who's long been keen to see more competition enter the Islamic finance space, I'm really excited to see StrideUp come into the market. They're available throughout the country. To find out more, head over to their website, strideup.co, to book a free consultation and apply today. Art is a fascinating asset class that has been historically the preserve of just the rich, and it has consistently increased in recent decades ahead of the stock market even. In particular, blue chip artworks such as those by the old masters, think Leonardo da Vinci and others like that, or modern artists that are really famous like Damien Hirst, Andy Warhol or Banksy, are proven to hold and increase in value over time. Banksy's artwork, for example, has increased by 675% since 2016. And when you look at the correlation between artwork and stocks, it's 0.04, so basically no correlation. So from that perspective, I would give it a score of 10 out of 10 on correlation. From a risk-reward ratio, if you look at the works of the top 100 most important artists and their artworks, over the last 18 years it has increased by 8.9% per annum, and over the same period the S&P 500 has only done 3.4% per annum. However, we're talking here about blue chip artworks only, and so from a risk-reward ratio I would give it a 7 out of 10. But therein lies the rub, because from an accessibility perspective, in order to get access to these millions of pounds worth of artwork, you have to be a billionaire, especially if you're going to build a diversified portfolio in this space. There are now places like Masterworks in the USA and a new company in the UK called Mintus that do allow you to access blue chip artworks for the retail audience. But even these guys are still restricted to accredited or sophisticated or high net worth investors. So from an access perspective, I would give artwork a score of 6 out of 10. Venture capital is an asset class that is really close to my heart because we run IFG.vc, which is our angel syndicate that invests in early stage startups. And exciting news, we're going to be launching the first ever IFG.vc fund very, very shortly, so watch out for that. When it comes to correlation, there is literally no correlation between venture and the stock market. Invesco did some research and they found a minus 0.06 correlation, and AngelList did some research based on their thousands of deals and they found literally 0 correlation. So on a correlation score, I would give it 10 out of 10 when compared to the stock market. The rewards in venture capital can be pretty spectacular. We're talking 100x, 1000x returns are possible. And we were actually working out our own returns on IFG.vc as part of our fund preparations, and we figured that we had done 35% annualized return over the last 3 years. Of course, venture is a high risk, high reward asset class, and so the best way to invest in this kind of thing is to invest in a basket of different startups and create a portfolio of this sort of thing. Overall, I would give venture a risk reward score of 8 out of 10. When it comes to accessibility to venture capital, it's a bit of a mixed bag. You do have really easy access to startup crowdfunding platforms, but unfortunately, they are not necessarily the highest quality. And those kind of high quality investments you find with venture capital funds and angel syndicates such as ours or on AngelList. Unfortunately, all of these platforms do restrict, including ours, to sophisticated and high net worth investors. So in total, I would give it an accessibility score of 6 out of 10. Private debt is basically what it sounds like. You're giving debt to private companies, whether that be for SME financing, property development, buy-to-let, commercial development. You're giving a Sharia compliant loan to some kind of private company as opposed to a public company. Debt comes in lots of different flavors, whether it's SME finance, property finance, corporate finance, ship finance, asset finance, all sorts of different things. When it comes to correlation, however, it does depend on the kind of debt you're talking about, but generally speaking, it's not that correlated, so I would give it a score of 7 out of 10. When it comes to risk reward, it's very hard to judge again because you can get a spectrum of returns from 2% all the way up to 15, 20% per annum, depending on the kind of debt that you're investing in. One thing to bear in mind though is that private capital is just money that you are ultimately lending out, and so you will be exposed to some degree of inflation of the capital that we're talking about. So overall, I would say a 6 out of 10 score is pretty fair to private debt. Private debt has historically been the preserve of institutions and the ultra high net worths. However, this has been changing over recent years with the rise of platforms like Gardos, Nesta, Funding Souk, Irad, and many others. These platforms do restrict to accredited, sophisticated, and high net worth investors though, so accessibility score has to be a 6 out of 10. Lastly, we have collectibles, where you have wacky things like watches, cars, NFTs, playing cards, all sorts of things. These asset classes are pretty uncorrelated to the stock market for obvious reasons, and you can actually make some decent double-digit returns if you know what you're doing within these asset classes. But at this moment in time, because they're so hard to understand and get into, the accessibility score is going to be pretty low. Overall, I would give it a score of 10 out of 10 for correlation, 7 out of 10 for risk to reward ratio, and 3 out of 10 for accessibility. Phew, that was a lot of alternative assets. Right, let's now tot up the scores and see which alternative asset did the best. So with crypto, we've got 22 points. Real estate, we have 19. Art, we have 23. Venture is 24. Private debt is 19. And collectibles is 20. So the asset class that did the best were venture capital and art. However, it has to be said that the spread was pretty narrow between all of them. Ultimately, look, I think that putting your non-stock portfolio across a handful of these alternative investment strategies is actually a pretty sensible approach. But there's a big caveat to all of this. You see, the trick with doing successful alternative investing is to make sure that you're getting best-in-class access to each of these asset classes, and you're diversifying within each asset class as well. And the best way to do that is to invest via a really solid fund or pooled vehicle that gives you a broad range of exposure. And inshallah, with IFG and the launch of our alternative investing platform, we will be doing that for you. So watch out for that. And for all of the alternative assets that we don't cover, we'll point you in the right direction. So that's it for today, folks. I hope you enjoyed it. Please do let us know in the comments below which are your alternative assets of choice and which alternative assets we haven't covered that perhaps you'd like us to do a deeper dive in the future. Until next time, Assalamu alaikum.